In your market news, global stocks are set to end the week on a tepid note following 7 weeks of gains after hotter than forecast U.S. inflation knocked back bets for how soon and how often the Fed will cut interest rates. Locally, shares in fishing group Oceania rallied almost 5% at one point after it said record global fish oil prices are expected to help lift its basic headline earnings by 60% in the half-year end to March. A strong operating performance in the U.S. and the weaker rand contributed to the group delivering a 13% rise in revenue. To give us more perspective and help us look back at the week that was, we are joined by Warwick Lucas from Galileo Securities. Warwick, thank you so much for your time. I mean, following that bigger than expected PPI figure and then you add in that strong US CPI report, what's the mood right now when it comes to the market as you look back at the week?
Right, Tash, I think we're talking about a market that is just becoming that little bit more cautious. I mean, I would say that looking in the context of the whole of 2024, I mean, markets have remained resolutely positive. I think still taking a view that the interest rate cycle is topping out, but clearly some expectations now that inflation could be a little bit more niggly than was expected, and I think that's tainting some of the fizz in that champagne.
Let's look back then at that week because we had a lot of company earnings coming through. Which caught your attention?
So I was quite interested in Standard Bank. Just purely as a kind of a worked example. You would have seen there a fantastic annual result. I mean, we're talking about earnings growth in the high 20s there, and yet the market punished it after those results came out. Well, some of that, of course, was that the best part of those results happened in the second half, the first half of the year. Second half was quite a lot more tepid, and we also saw that most of the growth starting to come out there now from the Africa businesses rather than the South African businesses, which have been fairly stagnant. So quite a change coming through in the leadership on where their earnings are coming from there. The other issue surrounding banks is that they typically struggle a little bit more when the interest rate cycle is topped out. And that the realization there that actually the banks are going to have to work harder for their earnings in the next couple of years, possibly also coming through there as well.
I'm curious, what's your assessment of the local equity market?
Okay, so if we were to ever hope for a day when you'd get a really, really big secular performance in South Africa, you would basically need three things. You'd need a high starting point cost of capital, you'd need restoration of economic growth, and you'd need investor-friendly authorities. Now, very clearly, looking at our interest rates and share ratings, capital is certainly very expensive. However, growth in SA is very slow, and it requires some very real progress on Eskom and Transnet to actually start triggering or enabling a turnaround. And then finally, I would say, well, government is perhaps a little less investor-unfriendly than it was, but it's frankly got quite a bit to improve. But fortunately, I think the understanding is really hitting home that government has run out of money and there's some real reform that is required, and I think some traction at last on the score.
So with that said, do you find local equities attractive, or does it depend?
I think it's still a case that there's pockets, because at the moment, with the current state of growth, you basically have a situation that local equities are a zero-sum game, where there's one winner and the rest basically all struggle like mad. So, picking out that one winner, well, that can be quite tough.
So let's talk states for a bit and focus in on those June Fed rate cut expectations. Is there any reason why June seems to be the baseline here, or at least the reasonable baseline for those rate cuts?
So I think to some degree it was a function of convenience. I think also the start of the US summer holidays and I think also it's really kind of a quarterly type point in time, June being the 6th month of the year. So the current interest rate futures there have run about a 65% probability of a cut. And I mean, that's still positive, but perhaps a reduction in enthusiasm. I think, looking generally at interest rate data and so on, I mean, the bond market has been creeping higher all of June 2024. So that's sort of showing a sign of caution coming through in those bonds. But I think you'd describe it more as caution than alarmed. Precious metals are, however, ringing alarm bells. So you've got a split in opinion there that's going to be quite intriguing to watch play out.
Right. Warwick, thank you so much for your time. That is Warwick Lucas from Galileo Securities.